So good afternoon, everyone. This is Margie Russell, Executive Director of NYARM. The prevailing wage law that came in a couple of months ago. We're looking on down the deadline of February 15th to file information, and that's all I'm going to say about it because the speakers are the ones that are going to fill you in on this. But at this moment, I would like the speakers in the order that I asked to introduce themselves and their company. Okay, so this is excellent. So we're going to start. Drew Donovan, please introduce yourself.
Margie, thank you for having me. I'm with Choice New York Companies, third-party property management, building staffing, and brokerage. When I was growing up, I never anticipated being on a panelist for something like this. I was hoping it'd be sports related, but here we are talking about prevailing wages and condo co-op abatements, and happy to inform the audience. Thanks for having me, and I'll hand it off to Mindy.
Hi, my name is Mindy Eisenberg-Stark. I'm both a CPA and a certified fraud examiner, and our practice audits about 100 co-ops and condos in the New York metropolitan area. And thank you, Margie, for having me on the panel.
Thank you. Richard Montagna.
Good afternoon, everyone. My name is Richard Montagna. I'm the managing partner of Barron & Montagna. We provide accounting and auditing services to over 200 cooperatives in the New York metropolitan area. And thank you, Margie, for having us. Thank you.
You're welcome. Robert Ferrara.
Hi, good afternoon, everybody. I'm Robert Ferrara from the Ferrara Management Group. We're an accredited management organization. We cover the New York metro area, manage approximately 92 co-ops, condos, and homeowners associations in the area. Margie, congratulations on your 20 years, and thank you for having us today.
You're welcome. You're welcome. Joseph Rodriguez.
Good afternoon. My name is Joe Rodriguez. I am Assistant Controller at the Ferrara Management Group, and I also manage all the payroll for the properties that we manage.
Hey, thank you. Welcome. So at this point, we will start with Drew Donovan, Chief Operating Officer for Choice New York Companies. And Drew, I just have a couple of things I'd like to throw out. Hopefully you could cover them. There's something called a 467A requirement, and what is it? How does it impact? And the prevailing wage. What do you do to calculate and start a decision tree? And then how do you calculate the benefits? Because with the prevailing rate, it's not just taking a salary amount. There's a whole package with the benefits. How do you do that? And the abatement issue, co-ops and condos. Tell us more about that.
Yeah, happy to jump in. So
thank you.
467A has been around since the late 1990s, and depending on the assessed value of the property, it provides a 17.5% to 28.1% tax abatement to condo and co-op primary residents who qualify and apply. This law and change does not impact anything for rentals. So the new requirement imposes prevailing wages on buildings applying for the abatement. It doesn't impact buildings that are getting a 421A or J51. It's less likely to impact a building that's already employing 32BJ union because their schedule mirrors the collective bargaining agreement when it comes to prevailing wages in 32BJ. And barring the aforementioned, who it impacts, any condo or co-op with an average assessed value of $100,000 or more is going to be impacted. So if you have $1 million assessed value for all lots and you have 10 units, you would be at $100,000 average assessed value. Primarily, that impact is to Manhattan primary residents, as well as very nice areas in Brooklyn and Queens with higher assessed values. Beyond that, any condo or co-op with an average assessed value of $60,000 or more and 30 or more units will be impacted. So you're going to see buildings all across Queens, Brooklyn, Manhattan, and other boroughs impacted by this. I mean, Long Island City, Williamsburg, downtown Brooklyn. Many people are going to be impacted by it. To understand if the building is impacted, check your notice of property value, speak with your managing agent, or speak with the tax attorney for the association or co-op. I wouldn't trust the notice of property value or the list that the Department of Finance put out saying the impacted units and buildings, because we found inconsistencies in what they're reporting relative to the notice of property value and speaking with tax attorneys. So the prevailing wage and how do you calculate it? There's a bunch of components to it, but it's a schedule, like I mentioned, that mirrors 32BJ's collective bargaining agreement. It's based on role. So for our industry, it really impacts your handyman, who is your super in this case, your porters, your concierge, your doorman, your security guards. So for the handyman, you're looking at roughly $30 an hour. For concierge, doorman, porters, you're looking at $25 an hour with tenure. So you have a 75% wage rate for the first 21 months of employment. For the next 21 months of employment, you have an 85% wage rate. And then after 3.5 years, 42 months, you're at 100% of the wage rate. And just to break that down, if you're paying $25 an hour and you hire a new employee, 25 times 75% is roughly $19 and change an hour. That's what you're obligated to pay them for the first 21 months of employment, with annual increases as the comptroller schedule is released. You have $19 for unarmed security, and then you get into the benefit rate. And the way the benefit rate, I mean, some people look at it, think it's half the wage rate. Really, I mean, what I've come to find is it mirrors the benefits that 32BJ puts out for health, pension, and other funds, which is roughly $2,700, $2,600 a month times 12 months, divided by 2,080 work hours in the year. And then you back into a benefit rate of roughly $15 an hour. Handymen get that benefit rate after 3 months of employment. So their 4th month going on, they're privy to that entire benefit. And for doorman, security, porters, unarmed security, it's really like a first 3 months, no benefit. Next 4 month through 12, you get $10. So it's roughly 70% of the benefit. And then for the next 12 months beyond that, so months 13 through 24, you're very close to the total $15 amount, but not quite there. And that's what you're getting paid. Once you're 24 months in, that's what you get. And there's a way to offset it. So if I am an employer and I'm providing a 401k and very sufficient employer premiums on the health insurance policy, whatever you're paying, you could divide that by the 2,080 work hours in the year and calculate what you're providing them and back that out of the wage. So say, for instance, that calculation comes to $3 and the benefit rate is 15, you now have to pay $12 an hour. One very important part of or component, you only pay that on up to 40 hours of work. If you work more than 40 hours, you're not obligated to pay the overtime rate. So it creates a lot of nuances for Ferrara, us, and other managing agents out there that have to calculate this on a weekly basis. And if I have a super or porter that work 10 hours in the week, I have to have a separate wage rate or bundled pay to pay them. It's very nuanced. It's not that complicated, but there's a lot of room for error, and it doesn't make it easy with a lot of the payroll platforms that we have to work with. So that's pretty much the wage rate, the benefit rate, and how to break it down. For us, we're weighing the option primarily. I know there are other impacted services, but we're looking at what the tax savings is for the association. So if we knew we have a 200 unit condo and we knew 100 people were applying last year and we have 15 more people applying this year, and this is a building that's being impacted. You take those 115 units, you get the residential common interest, and say it's a perfect scenario, 115 out of 200, you have 60 or 57.5% is what the tax savings is. So 57.5% apply times the total tax assessed value times the tax rate. times 17.5%, because that's what the abatement will be for $60,000 or more. You're going to be able to calculate what your savings will be on the condo co-op abatement come July 1, 2022 through June 30th, 2023. And then you're taking that cost analysis and comparing it to what are the implications. If I just have a super or a porter that roams and works 12 hours and I'm in Manhattan, Tribeca, Soho, it's probably going to make sense for you to apply for the abatement. But if you have full service doorman, a lot of porters, large staff, these, I mean, mentioning free market wages of roughly $18, $22 an hour, now jumping to $40 an hour, it really puts a heavy, heavy burden on the payroll for that association. So there are some benefits to doing it. You keep staff more, but it's a mixed bag. It depends on the board you're speaking with. If it's very investor oriented or sponsor oriented because it's a startup building and the cost of deploying prevailing wages far outweigh the tax savings, this is something you would likely put off and then file for next year. So I know that's a lot, but I wanted to put everything else out there. That's how we're weighing it. What are the cost increases? What it in comparison to what the tax savings would reap?
Drew, this is Margie. So were you pausing or you completed your formal presentation?
I completed the formal presentation,
Okay.
unless you want me to talk for another 10 minutes.
I would love to, but we're going to continue and hopefully you'll come back in and make some more comments. Okay, Mindy Eisenberg Stark, CPA.
Hi. So to piggyback on Drew's comments, basically this is for the abatement year beginning July 1, 2022. There is a form, an affidavit that will need to be filed by all affected buildings, and the deadline for that form as of right now is February 15th, 2022. And basically what it states is, even if you are a building that has no employees, but you are in the demographic where you need to file, you still need to file the form stating that you have no employees. And someone just put in the chat that the deadline was extended to April 15th. That's exciting. I'd actually been checking to see if there was an extension, but it appears now that there has been. It now coincides with the IRS federal tax deadline. So it's prospective. So therefore, I do not believe that the wages would need to be changed until July. And Drew was citing a lot of the rates, but there is a new 32BJ contract that's coming due. The old one expires at the end of April of this year. So those rates will probably increase based on the increases in the 32BJ contract. So there's the filing requirement. And again, even if you have no employees, you need to file that form and check off that there are no employees. Some of the questions that I've been bantering around with some of my colleagues is, where does an apartment that's given to a member of the staff, specifically usually the super, how does that fall into this calculation? And my understanding is that the apartment would count towards the benefit rate. And there is specific guidelines as to what the value of the apartment is based on sizes of the building, et cetera. So you would need to look on that on an individual basis. I think that this is going to become a fairly large issue. The shareholders and condo owners are going to want to have their co-op abatement. It will have to be an education process as to what the effect would be on their monthly maintenance, as opposed to what their co-op abatement would look like. My reading says that even if one unit applies for the co-op abatement, then the building has to comply with the prevailing wage rates. The flip side is going to be, individuals in buildings who were not aware that members of the staff perhaps were not being paid a prevailing wage, and the morality and ethical considerations of how those shareholders might feel, knowing that perhaps members of their staff are not being paid a living wage. We came across that recently in some of the nonprofit organizations that we work with here in our firm. People were somewhat outraged when it became evident as to what people were being paid. So I think that this is going to, as Drew mentioned, it's three components. It's not just the wage rate, but it's the wage rate, the prevailing wage, the benefit rate. There's also an overtime provision in here, and there are also paid holidays. So you will now also, in addition to paying the prevailing wage, benefits, et cetera, you're going to have to give off the holidays that are in the 32BJ contract, and you're going to have to pay for those at more than just the base prevailing wage rate. So it's a very complicated calculation as to what will need to be done to increase potentially the salaries of these non-union employees. The fact that they were going to give us only till February 15th was making it very tight to make these calculations. I think given the extension till April, everyone's going to have to start picking up their pencils and start calculating, because you're going to either affirmatively state that you're going to comply with the new provisions, or if you're not, you are going to, the building will lose the impact of the co-op abatement program. So there's a lot of decision making here, and I think it's really going to have a major impact on the industry.
Thank
Well,
you, Mindy. Yes.
I was just going to follow up and say that certainly I agree with everything that's been said so far. My phone's kind of ringing off the hook because nobody has a clue, and given a February 15th deadline, I'm sure that most people still won't have a clue by February 15th, given the various permutations that have to be made in terms of determining the wages and the benefits. I think that the moral situation is going to be a big one as to whether or not people want to pay the wage or give up the abatement. And I suspect that's going to be made at the board levels, and that may be causing some problems with shareholders and unit owners the same. I also know that there are quite a few self-managed buildings out there that are not going to be able to manage this on their own. And they have a difficult time with payroll as it is. So determining these wages is going to be a difficult task. There's also been a situation in the past where for those non-union buildings, the effort was to keep the benefit level at a minimum. And that's going to be contrary to this formula if in fact they want to comply with the prevailing wage rate, because it's either the dollars in the benefit rate or the premiums that are going to be paid or the pension that's going to be paid. There's been a lot of talk about what should be included in the benefits. And as far as I know, it's only the three items, whether it be health insurance, pension, or the apartment. And I don't think the apartment value is, it may be the easiest thing to determine, assuming there's a rental in the building. But the fact that this could change from month to month makes it extremely difficult. So with that, I'll leave it to discussion. I'm very glad to see that the date was extended, although I'm not sure how we can do the affidavit, file for the abatement early and then have the affidavit later. It seems to me that the two of them go in lockstep, but maybe I'm wrong.
I think there's an intention to allow people to opt out after the fact. So you're filing for the renewal, but DOF will release a functionality that allows you to subsequently redact what you submitted and opt out. I think that's the intention.
That's good.
One other thing I just wanted to mention that came to mind is that some of the material I've seen has extended this prevailing wage rate to contracted services. So many buildings try to go around the, having to pay benefits, et cetera, by contracting services. What I've been reading is that in that case, let's say, for example, you hire a landscaper, that you would have to track the wages being paid by the contractor to make sure that in fact that people who are working on the property are getting the prevailing wage. And I don't know, I'm throwing out to the other professionals whether they've seen this and what their thoughts are on that.
So speaking from our standpoint, I observed that as well. And again, it's just more complication to the overall management property within New York City. It's adding more cost onto the properties that we're managing, more chances to lose abatements or obtain fines from the city. So it just complicates the whole process. Based on the employees, it's going based on the job title, the wages that they're being paid, the length of service at the property. So that's the easy part to figure it out. Now, if we have to figure out the vendors that work for the property, what they're paying their employees to come in, it just continues the complication.
Just to follow up, actually, on something that Drew brought up earlier was the multiple wage rater. It is a bit of a mess. We've set some guidelines with our payroll company as to how to separate them, and then we track them on our end by having separate GLs to be able to coordinate those numbers. But it is a lot to juggle as you have different properties with different wages and how to record it when we report those wages. So again, to follow what everybody else is saying, it is going to be a handful.
It's going to be a board issue as well. We've had situations in most of our buildings that operate on budgets that they adopted last fall, or even as recently as December, without even considering the budget impact of this particular provision here. So if in fact they're going to pay the additional wages, they may need a mid-year budget adjustment, which is not going to go over well with shareholders or unit owners either. And even absent that, when you put in the fact that they could lose the abatements, that's going to be a whole nother issue. So the burden on the board members is tremendous.
Overall, what we're seeing in our properties that we manage, the majority of them are union properties. So that made it a little bit easier, as Drew brought up. It mirrors basically the union contract and the benefits that they receive. To also locate good employees. Most employees are looking to get paid what the union rate is along with the benefits, even if it's a non-union property. So a lot of the properties that we're servicing, they are going to fall within that range. So it hasn't been a hardship on us as we're doing these calculations. And to attract good employees, you need to have those rates. So I think overall, the properties that we're managing, they're going to fall within line and they won't lose those abatements. But small properties, as was brought up earlier, that may be a bigger issue for them. If they have a part-time super, maybe the guy next door that's handling it, they now have to come within compliance.
We've also found that in some of the boroughs that there are buildings that have opted out of the union and have, in order to keep the maintenance levels at an affordable rate for the shareholders. And what this is going to do is basically bring them back up to their previous union wages. And it will be interesting to see what will happen to maintenance rates and whether it may perhaps even make some of these these buildings unaffordable for the people who are living in them at the time. You add that to the fact that we're still a little unclear about the reserve funding requirements of the 10% based on the new Fannie Mae and Freddie Mac guidelines. These budgets are, as you stated, Robert, they're going to go haywire because there will almost certainly have to be mid-year raises if in fact they want to keep their co-op abatement in place.
Any questions from the floor? We have one in chat. We have a Bronx Super. RD, would you like to ask your question? Is it Randy Donovan? Randy, you want to unmute yourself? Let's see.
Do you want to just ask the?
Yeah, so go ahead.
Go ahead.
I think the question is from Ms. DaCosta concerning the Bronx Super.
Okay. Well, if someone would like to address that, that would.
I'll read it out loud just for everyone. We have a Bronx Super that not only has his apartment covered, but also has another job. Does this make a difference? He is also a doorman in Manhattan.
I can take it if nobody else wants to. I mean, a lot of people excited to answer this here. So if he's working elsewhere, it doesn't matter. You're worried about what he's working in your building, and you're calculating the benefit rate based on those hours divided by 40 and the actual wage rate, whatever it is. So if he's truly a super and doing handyman type work, you're going to be paying him $30 an hour. And then the benefit rate you are able to reduce by whatever you have for a comparable property in the building. I do believe that's a gray area. You don't want to be egregious with it. But if you're in 11A and 12A just rented for $2,500 a month, I think that's very fair to use that as substance. 2,500 times 12, get your amount divided by 2,080. That's what you can subtract from the benefit rate. And you're only obligated to pay the benefit rate based on the hours worked. So it doesn't sound like that person in particular is working full time, and they wouldn't be privy to the full benefit rate on a weekly basis.
Okay. Thank you. I have a question for the panelists, Margie, which is, from what I understand, the prevailing rate was always a requirement in buildings where there was some type of government funding. I'll use that loosely, but some type of government funding flowing through that property, and the prevailing rates were a requirement. I'm curious, does anyone know why building service workers and not airport workers, or why this building service workers with the prevailing rate? Did someone in some body of government feel that those not in the union were being poorly underpaid? I'm just curious the origin for this. It just seems like it's a carve out.
I think it's because it's being tied to a benefit that's coming back to the individual shareholders and condominium owners. So it's not just that they've decided that this group needs to do the prevailing wage, it's that they're tying it to a benefit that comes back to the building. So basically, if you want the benefit, you need to increase the wages. So it's a give and take, and I think that's why it was singled out.
Okay.
And prevailing wage has been around in other counties for other different services. So this is particular to us. It impacted us before with 421A. Now it's even more so with this new requirement.
Okay. And since we have all the accountants on the phone here, okay, let's see. Not the prevailing rate, but the the Mitchell-Lama buildings, you know, that broad group of buildings that do have government funding flowing through it, and there's all sorts of requirements that are separate for them. So, for example, in those management contracts, as many of you management companies know, in those management contracts, it includes requirements for having certified building staff, management staff. It could be one, it could be a group of people, but there are certification requirements. There are many requirements in those very detailed contracts for those buildings. So I just wanted to make a comment on that, and I can tell you that there are many who do not follow that. I just know that. So it's something that has to be attended to as a group. We have to get on that, because if you're not following the contract rules, it can backfire, and I don't know how that backfires, but it's not good. There's, you know, people with expired certifications that they got the building, years go by, they replace, so they just let it expire. So it's just something that it's part of that when government money flows through a property. So is there anybody that can describe? Okay, we know it's the Mitchell-Lamas. We know, you know, what are the acronyms or the names of the types of properties that fall under that prevailing wage, where it always was before, for example. The HDFCs, Mitchell-Lamas.
I don't want to touch that because I don't necessarily know. We don't do a ton of Mitchell-Lama, but I mean, 421A is incredibly nuanced in and of itself. I mean, 421A 16 has a different burden than 15 did. Now it's 30 or more units. Before it was 50 or more units if construction commenced after a random date like December 28th, 2007. So and beyond that, I don't want to comment on any HDFC, Mitchell-Lama. It's not my specialty. I don't know if anybody else up here has the answer to that.
I'll jump in and say a few words about it. I do know that we represent quite a few Mitchell-Lamas and HDFCs. They are all getting some benefit, whether it be a lowest real estate tax rate through shelter rent. But I will say that I don't know that of any that are not union buildings. I do know that when they do refinance and the city provides financing, perhaps at discount rates and or subsidies that go with it, they do require that there be prevailing wages paid. There are some nuances with whether or not that has to be done. And I do know it's been a problem because most of these Mitchell-Lama buildings have private security forces. And to raise the security force to a medium wage is huge in terms of expense. But apparently based on median wages in the building and so forth, most of the instances that I'm aware of, we've been able to get around it. It'll be interesting to see whether or not this provision is going to cause any problems with the security contracts at Mitchell-Lamas at all.
Someone just asked the question, do buildings with salary employees with no set hours need to comply? I believe that it applies to any employees who work over 8 hours a month, if I'm not mistaken. Excuse me, if I'm not mistaken.
I concur.
Yeah, okay.
There always has to be some set hours because you're subject to, you know, overtime hours, even if this provision didn't exist. So there has to be some hours and some requirement attached to that wage.
Margie, can I mention something?
Absolutely.
I uploaded the comptroller schedule in the chat. It lists Class A buildings, Class B buildings. So there's a minimum work hour requirement, which I believe was just mentioned. Every category of worker in that comptroller schedule is required to receive the prevailing wage. And as you see, if you look through it, it's not just porters and handymen and security. It's almost anyone that might work in your building. It lists garage service workers, it lists landscapers, it lists window washers, it lists locksmiths. So I think it would be a good idea for everyone. As far as I know from the Department of Finance, that comptroller schedule, any worker listed on that schedule is required to receive the prevailing wage.
I'm in agreement, and I think they're setting us up for failure. It's impossible, I think, with HVAC technicians that you're already being charged $2.25 for the hour, and plumbers, you're fine. But as you mentioned, window cleaners, who knows what they're getting paid. I don't think this is something realistically you could comply with. I mean, the Department of Finance website doesn't even work when you're uploading a renewal, yet they're expecting us to comply with egregious measures. How are we supposed to manage that on top of what they've already thrust upon us?
Margie, this is Jerry. I'd like to jump in on the budgets. When
Please
there's a
do.
moment.
Please do.
Okay. First of all, in regards to the last comment, no job's too hard for the person who doesn't have to do it. So I'm left with that particular saying from many years ago. But this is Jerry Niemeyer. I've been working with co-ops and condos from a lending viewpoint for the last 25 years. Prior to that, I was in the CPA business, but not necessarily with co-ops and condos, but nonetheless, I did know where the debits and credits were. I've also been a board member of my own co-op in the past and understand the budgets and things like that. But I wanted to address the point that Mindy brought up in regards to the 10% reserve. There's been a lot of discussion on that in the last few months since Fannie Mae came out with their enhanced guidelines, if you will, as a result of the condo collapse that occurred in Florida. And the one thing about the 10% reserve, that rule really applies to condominiums. It does not necessarily apply to co-ops. We are looking at both co-ops and condos to make sure that they do have structurally sound buildings, that there's no egregious issues with engineer reports or anything along that line. And we're to look at that for both co-ops and condos. But when it comes to the budget, there's more flexibility with co-ops than there are with condos. They're looking for us lenders when we're reviewing buildings. This is for residential lending, that we make sure that that they have the budget showing the 10%. So they, that's what we're looking for. And they almost, well, not almost, what they did in this revision, they said it's not an option. You used to be able to have a reserve study with a condo to say, oh, well, you don't need to have a 10% reserve. Our reserve study says you can just be putting 5% away and you'll be good. Well, no, not now, not for this period of time. They say it's temporary, but we'll see how temporary things are. But that's where the 10% comes from, and that's for condos. With co-ops, like I said, there's more flexibility. There is because you do have the ability to borrow more money if you need. Maybe your underlying mortgage is pretty low, and now you need to do some work. Well, you could perhaps either refinance your underlying mortgage or get a second or third mortgage. Of course, up to the limits that the underlying mortgage person lender would permit. But I know that some of us on the call here had some discussions with our folks at Habitat Magazine to try to clarify this. And, you know, it's a new thing. So it's going to take a while for all the lenders to kind of work this out. You know, maybe all lenders think it applies to both co-ops. I mean, some lenders think it applies to co-ops and condos, but I can tell you after my discussions with Fannie Mae, it's co-ops is as it's always been. With condos, it's a 10%.
Thank you, Jerry. That was excellent.
Jerry, if you don't mind, I'd love to follow up with another comment, and I'm a little curious about it. I don't know if you have any experience with it, but we're getting a lot of activity from lenders, specifically for purchasers, where the lenders are actually either looking for that 10%, or if they see budgets that where we've had deficits in a year or two, and maybe have something projected going forward, that they want an affirmative action from the board to tell us how that's going to be funded. And, you know, just from my experience, it seems to me that perhaps these inquiries are coming from lenders that are dealing with perhaps borderline borrowers, because I don't see it across the board, but we are seeing quite a few instances of it. I'm just wondering if you had any experience with that and could provide us with some insight.
Well, that was the point that I was trying to bring up, Richard, is that you got different groups. It's not Fannie Mae that's you know, they're not submitting all these things to Fannie Mae and they say yay or nay. No, every lender's that's been doing co-op lending, they're delegated by Fannie Mae. They have to, you know, prove to Fannie Mae that they understand co-op lending. Now, a lot of that proof in their doing was done some years ago, or maybe even months ago, before these particular pronouncements came out. But as I said, the various project review groups and the various lenders, they may not all be following exactly the same way as I described it. Now, theoretically, if the borrower is a little shaky, in other words, I like to say, with co-op lending and condo lending, there's 3 legs to the stool. 2 legs are common for all loans, whether you're buying a single family home or a condo or a co-op or anything else. And the 2 legs that are common is that you, the borrower, have to be creditworthy, and 2, the appraisal has to support the loan you're requesting. The 3rd leg, which is what I've been doing for the last 25 years, is reviewing the co-op and the condo to make sure that it's financially viable and demonstrably well run. There should not be, you know, I know that there may have been times where some underwriters say, well, I don't like this borrower. We're going to say the project is no good. And we chafe at that quite a bit. It shouldn't be that way. If the borrower is not creditworthy, that should be so stated. And let the co-op or the condo stand on its own. So yeah, are there differences? Yeah, I can assure you there's probably differences, but I don't know how to get everyone in compliance.
Thank you.
Okay.
So if we were to get back to the prevailing wage issue, there's a question in the chat with regard to vendors on the property. And, you know, I think that we're going to, you know, based on the way that the rules are written, it would seem to encompass their staff if in fact they work on the property more than 8 hours a week. But remember, this is all brand new legislation. And I think we're going to have to wait and see how this all trickles down, at least after a full year of compliance.
Mindy, that's very interesting about the more than 8 hours per week, because if there's a roofing job going on, or any capital improvement, that a crew would be there easily for more than 8 hours a week. So, and now does it, if 8 hours a week, and then does it have an annual or a quarterly cap or something, or is it just 8 hours a week?
I'm not aware of a quarterly or annual cap. The legislation just spoke about 8 hours per week. But again, I think we're going to have to wait and see the trickle down effect on the vendors versus the direct employees. Also, based on what my read is that even if you were to perhaps use a PEO, which is a payroll company where essentially it appears as though on the W-2, the individual is employed by the, let's say, an ADP or a Paychex, they would still need to be counted as employees of the building and need to comply. So I think that a lot of the workarounds that people have maybe started to think about, I'm not sure that those are going to work in this situation.
I actually have a question. Do you mind? I have a question for Richard, Mindy, Joseph and Robert as well. I found conflicting info from the Department of Finance and from attorneys, labor attorneys. I've heard two different answers. Collective bargaining agreements with a local 670 or 486 or a union that's generally less expensive than 32BJ. If they have that union in the building, my understanding from the assistant comptroller is that you have to pay prevailing wages if they exceed that contract. I've heard conflicting information from labor attorneys saying that the CBA would supersede that. That was my original assumption, and I think I'm wrong. Does anybody here know the answer to that?
We haven't run into that in any of our properties, but I think if you take it the way most laws or regulations go, you have to be on the side of caution, and I think you would need to pay that prevailing wage. And that's what I would recommend to our clients, because we haven't run into it, so I haven't asked that question to any of the other professionals that we work with. But I think that's the smartest sense right now, because it is going to be monitored pretty closely.
Yeah, my reading of the legislation doesn't say that union buildings who have unions in place have their union employees exempted. It specifically just states that everyone needs to be paid the prevailing wage as set out in the controller's list of prevailing wages.
Makes sense. And I mean, for the smaller buildings, people trying to get away with paying 1099, the comptroller schedule is going to prevail. So you may be cute now, but when you get caught up in an audit, you're going to pay the price then. I mean, it is in your best interest to advise the associations to cooperate with this law to the best of your ability.
I would agree, but what will be interesting to see is how many employees the city dedicates to auditing and enforcing this law, and the people power that they hire in order to be able to do these audits. Because in order to basically do it correctly, it would be extremely onerous.
I think there's no question about that. The mention of the 1099 employee has a lot more serious ramifications than just the prevailing wage, I think, whether it be insurance or sales tax, somebody getting hurt on the premises. You have all kinds of situations with that going. One of the concerns I have is whether or not, if there is a non-compliance, is there going to be a clawback of the abatement? And this could be an abatement that has already been given to a particular unit owner. So that's going to be very problematic.
And I'd side with Robert's earlier comment of anticipating that there would be a clawback and hope there's not if any property is implicated by not abiding.
So the other question in there, which I haven't been able to find any information on it, are there any fines or penalties for buildings that submit the affidavit to receive the abatement, but do not pay the prevailing wage? I'm not sure if anybody else has information on that.
You do not want to get caught up in a prevailing wage audit. So yes, interest, penalties. I don't want to say they're double the original amount, but they're enough to do the right thing now. So I recommend nobody try and get cute with this. Abide to the best of your ability. I think we should also talk about sending a letter to all of our clients, increasing the management fee twofold. for all of this extra work. So
Now, Drew, is that just on the prevailing wage extra work or all the other extra work and requirements that we have to do?
I'm with you. I'm with you.
That's great. If any of the panelists have any follow-up statements, or if anyone in the audience that has knowledge on this, now is the time. We are coming close to our 1:30 mark, and I like to try to keep this on time. So, panelists.
Hi, it's Debbie at the Finder and Warren. Could I ask a question to the panel, please?
Certainly.
First of all, thank you all for all your time and professionalism. We've had a couple questions with respect to a porter living outside of the building and whether or not we could contribute by pay stipend an amount to their rent in an apartment outside of the employer. What's your feelings there?
I'll tell you what I would do, and then I'm gonna defer to Mindy because she reads everything and she's gonna know the answer. But I would err on, yes, you can take that. That is a gray area where you're providing a stipend and a benefit they wouldn't otherwise be privy to, but you want them in the proximity of the area, or it's another allowable expense as long as, contact Richard. You could talk about an accountable plan and expenses for this, but I would side on, yes, it is a benefit. If they weren't employed, that benefit goes away.
Okay, thank you. Also, where an employee is making over the required prevailing wage, the $26.45, could we move any of that overage over to the supplemental portion?
My understanding is that you can go the opposite way, that I believe that actually, let me, because I saw something about that, is that there was a way to move it, but I don't know that you could move it to the wages. I think you could move it towards the benefits. So
Oh yeah, that's the question, whether or not we could put the overage on the wage onto the benefit.
I believe so, but I want to just check that.
Okay.
So ask another question in the meantime.
Okay, I have another question. What if we have a building that is in excess of the assessed value at this point, but is filing certiorari reduction proceedings? How do we preserve our rights in the event that this current tax is reduced below the assessed value?
No clue. I really have.
Honest.
I'm facing it where we had mid-construction. We did an analysis of what the assessed value was based on 2020, 2021, 2022, and then you're forced. Legitimately being force-fed by a notice of property value coming out at the end of January to determine February 15th filing. So I would anticipate retroactively, but how do you know? If you're at $62,000 a unit, you don't know when that grievance is going to successfully go through. It could be
Correct.
2 years from now. So I would err on the side of caution, but truly don't know.
Okay, my final question, I think. If you are filing benefits and the building decides in a year or so to remove themselves from the co-op abatement program, is there an ability to carve back the extra monies paid, not retroactively, but the monies paid? So if we're giving a super an extra $15,000 as a pension contribution because we want to comply, what sort of agreement should we have with the supers or the porters to say this is a temporary benefit and can be revoked or can we not?
I think in a situation like that, you really have to have a employee manual in place that will describe that, especially with the regulations that the state has in place for the employees. So if that was coming from one of my clients, that my recommendation is to prepare an employee manual and make sure they're aware of it, they're given it, and any updates are presented to the employees.
Okay, and I assume the
think
same I'm sorry.
It'll be very hard to walk that back, though. You're going to have an employee getting a large increase, and now they're back to where they were 3 years ago. I think like the humane factors have to weigh into that decision as well. And that's a legitimate concern with the rent stabilization laws and the impositions. People are worried that 467A may eventually revoke
Right.
the abatement, and now you're locked into schedules. It's up to the board to decide.
Okay.
In
Thank
answer
you.
to your other question,
Yes.
if pay rate is above the prevailing wage rate, it can spill over into the benefits, but the benefits can't spill back into the wage rate. However, you have to be aware that if you are trying to do your wage rate high enough to cover your benefits, you're going to have overtime considerations, because when you look at 1.5 times the pay rate, you're starting with a higher pay rate because you're using it to supplement the benefits. So it becomes a multiplying factor. You're better off separating them, because otherwise you're going to be paying overtime based on those additional benefits that you're including in the wage rate.
Yeah, but we wouldn't put them in the wage rate. If somebody's making 60, part-time super's making $60 an hour, and we want to take half of that and put it into a benefit package.
Exactly.
So we're able to do that. So then we're in essence reducing their payroll to $30 an hour and $30 for supplemental, at which point we would not claw back if there was a reassessment or a revocation of the co-op or condo abatements.
Right. So
I mean, if you go, I'm sorry, Mindy, go ahead.
No, it's okay. Go ahead.
I think you should also be careful, because there's ever changing amounts on the July 1st. If you have
Right.
something like that example, instead of doing full wage rate, I would balance it. If I know the benefit rate is $15, I'd probably put that at $20, and I'd put the wage rate at 40. I wouldn't
Right.
make it perfect. So then you're good for a couple of years to come if you don't have any wage
Absolutely.
increases.
Absolutely. And do you feel the same way about bonuses? So somebody who's receiving a $10,000 bonus, since that's been a basic wage, that's something we could probably move to supplemental as well, correct?
Once it's a wage. If you're paying them, I think that is an
Okay.
amount you can remove. But I would more or less set the precedent with the employee. Hey, you used to be privy to this wage bonus because we appreciated your service. However, we're now obligated and we want to comply with this new rule. We're going to pay you a lot more, but do not expect the same kind of bonus going forward.
Okay. Very good. Thank you all. I appreciate it.
I think the concept of an employee manual and a clear understanding with the employees as to what they're being paid and what they're being paid for, which buckets things fall into, is going to become essential.
Yeah, that's what we're doing. And we're actually having the supers who are working that on the cusp of 8 hours or 9 hours to sign off saying that they cannot work over 8 hours unless they have, previous approval or there's an emergency.
So Margie, there's one more question in before we wrap up. Do phone reimbursements, uniform cleaning, travel count towards the benefit offset? From my understanding, it's really just the insurance, the 401k contributions that will go towards the offset benefit. It wouldn't
As
be
well as the residents.
and the residents, but not a reimbursement for uniform cleaning or phone.
In agreement too, in the subsequent or previous schedules. I mean, I know I've learned the hard way, vacation days, sick days, holidays in like 2018, 2019. Like, I mean, people used to calculate the benefit rate on what you were providing in PTO. You can no longer do that either. So do not do that.
And as you mentioned, the vacation, the sick days, the holidays, those are all part of this package. So you have to not only look at the benefits and the wages, but you need to look at the amount of vacation time you're giving, as well as giving the requisite number of holidays and sick time, et cetera. So,
and to make it even worse, they all don't comply. I mean, your porter, your concierge, they have different vacation schedules than security do. So it's not uniform across the portfolio. It's nuanced to each role.
Okay. Are there any other final comments as we close? I do have one or two announcements I'd just like to bring forth. Anyone there? No? Okay. well, I just want to remind everyone that we do this most every Tuesday and Friday. It is unusual. In the old days, an association would have one event a month, a breakfast, lunch, or dinner, education, a little networking. But since the whole webinar thing, excuse me?
Good. Good. How's everything? Can I get a heated up with just some black pepper?
I'm gonna take one as well.
Make that a double.
Okay. So Tuesday, we have how multifamily buildings can adopt commercial building technology, and that will be by Parity. They're an energy management company. But since we have so many accounting and controllers and CPAs on the phone, and you are the person who, when the property manager or the superintendent wants to get their invoice for NYARM approved, $250 a month, a year, a management company, $700 a year, please know that this is the type of programs that we run and support them in that. So with that, I thank you, Drew Donovan, Mindy Eisenberg-Stark, Richard Montagna, Joseph Rodriguez, Robert Ferrara, and thank you all. And please email me because I do have forms, I have links, I have much that I'd like to pass on to you, so to give you the benefit of the research we've done here. Okay. Thank you all, and stay warm this weekend.
Thank you, Margie.
Thank you.
Margie.
You're
Thanks.
welcome.
Thank you for having us.
Thank you.
Thank you.